So, welcome to the second part of our series on managing foreign exchange and navigating the markets in sub-Saharan Africa. The first session that we had was about understanding how a country works so that you can set expectations accordingly and manage your operations. In this session with Michele Maffei, and thank you again, Michele, for joining us, we're going
Thank you,
to
Damien.
start getting into a little more detail about what causes the liquidity differences, recognizing that each market is different and that it has a different liquidity profile. So Michele is going to take us through where the money comes from and what are the consequences of that. So with that, Michele, can you please take us through, share
Okay,
some of your knowledge with us?
thank you, Damien. So, in the first session, we introduced the idea that some of the defining characteristics, pillars of the foreign exchange market are transferability and convertibility, but at the heart of everything is the availability of liquidity. Because if there aren't any dollars in the economy, then effectively having convertibility and transferability is purely academic. So then the question is, well, what are the defining characteristics of and drivers of liquidity in African countries? And the interesting thing about that discussion is that Africa, by virtue of the fact that they are so at such an early stage of their industrial development, that actually is very straightforward to be able to see through the national accounts of the country and understand what are the drivers of liquidity. So clearly, the most important aspect of liquidity is really the current account. The current account is the commercial activity of an economy, and that is what is driving that is imports and exports of the traded goods and services, and then the remuneration in the form of dividends and royalties. So these are the current flows, the day-to-day flows that drive the economy. And in that, it's very, very important to always reflect on the trade balance and the terms of trade, which is really, where a country is able to earn foreign currency or pay for imports, and it's the balance between the imports and exports of the commercial activity. Very important to track that. And in fact, one of the reasons that we saw a substantial appreciation of the rand earlier this year was because the rising commodity prices, and particularly of primary metals and mining products, the terms of trade went very favorably in South Africa's direction, which meant that the currency was driven higher by a favorable terms of trade. So the currency appreciated. When a country, you look at its current account and therefore its activity, commercial activity, if there is an imbalance in that activity, i.e., they are importing more than they are exporting, then by definition, money has to come from somewhere to fill the gap. And that is where the capital account comes into it. So the current account is the commercial activity. The capital account is really about how is that current activity financed. And so that's where you get foreign direct investment, portfolio investments, borrowings and deposits, both at the national level and also by corporates. What is interesting about that is that many countries across Africa actually, and particularly countries like Nigeria, countries like Ghana, have become heavily dependent on the capital account flows to compensate for persistent deficits on their current account. Very important to understand that. And then if you look at countries like in East Africa, maybe in Uganda and Kenya, and to an extent Tanzania, you'll find that actually their activities are slightly more well balanced. And the reason that the capital account is critical is because if there are big shifts in commodity prices, right? Often one of the results of unfavorable shifts in commodity prices is that foreign portfolio investors basically withdraw their money. And we can speak about that a little bit later. And then clearly when you have a current account, commercial, the capital account are the investment flows, then any excesses or surpluses end up finding their way into central bank reserves. And therefore, what you need to do is look at the central bank reserves. So, for example, at the moment, if you look at Ghana, Ghana has lost $2 billion from its reserves this year in trying to defend the currency, whereas Nigeria has basically not intervened. It's not provided liquidity, and its reserves are up at $40 billion. Very important to look at the reserves because they are ultimately a final source of flows. And then finally, the last two factors I would describe are more of a qualitative nature. The first one is the perception of a currency's valuation. If the perception is the currency is is overvalued, then the danger is that portfolio investors in the capital account, as well as exporters, will hold on to their currency and not sell dollars to buy the local currency. And therefore, they will create shortages. And then finally, the seasonality. So is there a particular seasonal trend to do either because there are taxes that are paid at the end of the month, because there is a harvest for tobacco or harvest for other agricultural products or maybe cocoa, etc. So those are all the things that are really driving liquidity. And I think it's very important when you look at a country to understand its liquidity position is to understand these dimensions. Are they in persistent imbalance?
Okay,
This
so did you
conference
got the
will
idea,
now be
Michele?
recorded.
Okay, so thank you, Michele. That's very enlightening. One obvious comment is that I can think of a couple of very large Western economies or developed economies which live in a permanent imbalance and shortage, but they seem to be able to get away with it. Why is that such a big difference?
Well, so the imbalances tend to be on the trading on the current account, and the reason that they're able to do it is because there are sufficient capital account flows to compensate for it. And from time to time, when things get bad, then they have the European Union, which steps in and provides transfers. So at the end of the day, it's a balancing item, Damien. All the pluses need to have, all the minuses need to have pluses somewhere else. Um, and I think if you look at before the EU and the single currency, these persistent imbalances in countries like Italy and like Spain revealed themselves every 5 to 8 years. You would have a major devaluation, and that's because there were persistent imbalances that were not corrected by capital flows.
Okay, that gets us into a whole separate discussion, but we're not here for that one.
Yeah.
To come back to Africa, obviously, a lot of countries basically have structural deficits. So, what does that mean? Does that mean that there's really no hope for the future, and that you have to be prepared for this to continue being difficult, or do you see hope for these things changing?
Yeah, that's a very, very good question. Ghana is a country that is in receiving a lot of attention at the moment, and where this persistent and recurring problems. It seems every 3 to 5 years, Ghana seems to experience the same crisis, and they are undergoing one at the moment. I'd like to be optimistic and think that over time, as these economies develop more balanced commercial environments, like East Africa, like Uganda, for example, what happens is that they become less dependent on commodity flows. They develop more diverse economies that can generate foreign currency and take a longer term approach. And they are able to grow themselves out of this permanent difficulty which they're experiencing. Um, Unfortunately, it is a reality of these developing economies, and you probably need to look over a 30 to 40 year cycle before you can see things starting to improve.
I think most corporate budgeting processes have a slightly shorter cycle than 30 or 40 years.
I know.
But so you still think that these things will correct over the longer term, and there are some countries that are doing well. But for example, if you look at a place like Nigeria, which obviously is a very large market, would that say that we shouldn't be holding our breath?
Absolutely. I think the problem with Nigeria is that it is beset by unconventional government interventionism in the functioning of the economy, and a little bit like trying to squeeze a balloon. When you squeeze it in the center, it pops out through the top, and when you push it down from the top, it squeezes out down the sides. The problem with Nigeria is that now they have so many ways of compensating. So, for example, the fuel subsidy. The fuel subsidy, in order to keep the economy isolated from the cost of rising energy cost, that has an enormous budgetary consequence. The budgetary consequence then forces interest rates to be much higher than what they would otherwise be, and it undermines the credibility, which means that foreign lenders and foreign investors feel much more nervous about investing in Nigeria. So it is a concatenation of problems in Nigeria, and unfortunately, it will take many years of macroeconomic orthodoxy before they can be resolved. But as I said at the beginning, Damien, that doesn't mean that these are not commercially viable places. I think what you need to do is just to understand that getting your money out may need to be indexed at a rate that is different than the official rate.
Okay, thank you. One last question before we close this segment. You've mentioned it's important to follow the macroeconomic statistics. Are these readily available and are they reliable?
Surprisingly enough, they are. And there is a very detailed set of national accounts that can be tracked, and all of the dimensions that have been referred to here are entirely visible and transparent. And indeed, in at least the large countries that we are involved in. And so, out of the 54, I'd say there's probably 20 to 25 that are receiving a great deal of attention. In those countries, these statistics are both reliable and available.
Okay, thanks. So again, to summarize, it's important to understand if you're expecting to get money out of a country, it's important to understand how the money is going in. That means understanding the trade flows and any offsetting balances on the capital account. And it's important to understand that at the end of the day, the bottom line is if there's no money coming in, you're not going to get money out. And it's important to understand that when you're structuring your business. Would that be a fair summary?
That's exactly right. And particularly understanding the role of commodity prices, how the national accounts are affected by changes in commodity prices, and the role of foreign portfolio investors in providing those short-term capital flows that finance these economies.
Okay, that's great, Michele. Thanks. Very much appreciate and look forward to the next
Okay.
session.
Thank you,